Good afternoon, everybody. Great to be back, I would say, to the old normal, meeting people in the GTR. I think that's one part we have been missing, I think, in the real life. So thank you so much for that. Various interesting discussions which took place yesterday, this morning, and really thanking GTR for organizing this event so efficiently. So just as an introduction, I'm Milind Jain. I lead the credit specialty practice for Marsh in the Middle East and North Africa, which primarily covers the short-term trade credit business, political risk and structured credit, and also the surety bonds. And the last event which I attended in person, that was GTR around the same time in 2020. And if you really look back and look at the panel discussions which we did that time, I think none of us would have imagined the kind of challenges we would have basically in the next 2 years. So starting from the biggest health crisis our generation have seen, the trade disruption, the shipping costs going up, the shortage of containers, and a couple of other things which really disrupted the whole supply chain. And we'll be talking about a couple of those in the discussion today. But one of the key things which we'll be touching on is how all these events are really disrupting the whole trade finance business. And we got a very interesting topic to talk about, which is the future-proofing risk and what are the regional priorities we look after basically in the changing landscape. And we got a very interesting panel to talk about, which is coming from the trade finance industry, law firm, and also the corporate perspective, and the insurance industry. So let me introduce the panelist. Okay, so here she comes, Sarah Sabra. So Sarah is the managing partner for Thinkronyze by MAS LLC. The next one we have is Leroy. Leroy has been leading the trade credit and the political practice for Markel in the region. He's a well-known name in the industry, and he had experience working with a traders and also with a bank in India. We have Mansour Davarian. Mansour joined Demica in May 2016, having spent most of his career at HSBC Bank, and now he's looking at platform sales in the London, but looking after the region. We have Kevin McCart, who's coming from a law firm, and he's going to bring in perspective in terms of the money laundering and the sanctions and how they're impacting basically the regional business. And the last we have Michael Creighton, who comes from London and looking at the political risk and trade credit business in London and also looking after the region. Now moving to the topic what we have. The first thing which we have seen in the trade finance industry is around the frauds. And I think that has been a big concerning area for banks as well as for insurers. And I think it would be good to get your perspective, Mansour, that how you as a fintech basically addressing that particular challenge for the industry.
Yeah, of course. I mean, as we look to future-proof risk, I think the key element is actually looking back at the past and what we've experienced over the last 10, 20 years. And fundamentally, even in the last 4 years, we've seen significant volume of information coming from not only the pandemic, but also through a significant number of defaults we've seen in the region. So I think there are two sides to this story. There are the positives that we see through the government support for pandemic financing, and that being delivered through the bank network, and then subsequently some of the defaults that we also saw occur during that period. And when we look at those defaults, and when I personally look back, having covered the region for a considerable number of years now, I don't believe that fundamentally that a number of the defaults we saw in the commodity space were actually pandemic related. I'm of the view that fundamentally a lot of the transactions, there was line of sight pre-pandemic that some of these corporates had underlying issues. And again, just coming back to that future-proofing and how we can future-proof, some of that information is very much derived from the underlying data that we have access to and the analysis of the data that we can do. So again, having been in the market and met with a number of these corporates, there are certain things that we saw very clearly with respect to the provision of information to us as a fintech in the region, and some of the shortfalls in the quality of that data. And I would actually say things like when we look at commodity traders, the way in which the finances that sit behind us and work with us look at this is financing net positions, meaning that we have to look at both receivables and payables balances. When a corporate isn't willing to provide one side of the picture, it's something that sort of rings alarm bells from my perspective. Similarly, when we look at a corporate's systems in itself, when they're not marking invoices as sold, or they're suddenly transferring invoices to a different region to be sold or a different entity to be sold, that again is something that we should sort of be aware of as a key risk factor that exists within that corporate. And I think finally, some of the other things that we can pick up purely from the data of these corporates is billing anomalies. Should these corporates be selling and buying from some of these businesses? And actually, when I look back at when we decided not to move forward with a number of these transactions and not to sort of provide our technology into some of these deals, I'm not here to be concerned about the credit risk, but fundamentally, I'm concerned about my own payment risk as well as the credit risk for the funders that sit behind me. So I think I think that's where we need to start when we look at future-proofing trade.
Yeah, no, thanks for Mansour for that. And I think it's a very interesting perspective because if you look back, I think around mid-2020, a lot of the European banks actually pulled out from the commodity market because their main concern was not the return on capital, but it was actually return of capital because they were actually discovering frauds one after another. And it's not only banks, I've seen even insurers suffering because of that particular thing. And this is where, Leroy, I would ask you to come in. How you see, because if you look at frauds, these are not the frauds which have triggered because of COVID.
Yep.
These are actually the system failures. And if you look at the industry, they're not new. If you look at the region, they're not new. So how insurers are actually making their underwriting more fraud-proof? What are the steps insurers are taking to make sure that they're actually supporting the genuine business?
Well, that's a very, very good question. And, obviously, jumping straight to what Mansour's comments is, of course, data. But let me just backtrack a little bit. I think the fundamentals of basically on how we move forward, and yes, someone who wants to defraud the system will find new ways, new technologies to do it. But there's certain traits that we can pick up, certain signals, early warning signs, etc. And one thing we, as an insurer, I'm sure banks, as everyone in the trade flow, supply chain, probably would have done this. But if we don't learn from the past, we're forced to repeat it. So what we have done is looked at the last 10 years of data. What are the early warning signs? What were the traits? Which sector? A very good example is if you look at a commodity trader and you say, okay, what value is he adding in the supply chain? Is he just moving documents just to kind of build liquidity and then create a parallel finance market, conduit trading, phantom shipments, bills of lading, finance money? These things kind of disrupt the ecosystem in a large way. And what happens is, sitting on an earlier discussion yesterday, is a massive gap in finance. We're talking about $2.5 trillion, and probably figures in 2022 or 2023. A lot of this finance is basically a flight to quality, where people like us, banks, and others want to just chase quality risk. But there's a whole gap which is SME related. And one of the reasons why this is not reaching there is because trust and confidence is not there because of recent past experiences, and therefore everybody wants to play it safe. So the way we start is very simple, is if I were to get an application, and just very rudimentary, the first motive is, why does someone want to buy that insurance policy? Okay? Who is running the show? It's basic fundamentals. What's the value that they're adding in this business? What's the motive? Is it more finance related? If it's more finance related, obviously then the due diligence needs to step up. But it's important to get the first fundamentals right. And having done that, we were kind of able to miss some of these big ticket items and sometimes you might get it wrong initially, you may come onto a program, but it's important that when these red flags come up, every insurer or bank needs to kind of find ways to address it, because there's systemic problems which happen later on, and that's exactly where we are at the moment. There's a lot of liquidity, but there people are concerned as to the confidence of whether they get paid back if they kind of go down tier 2 and tier 3 in terms of lending.
Yeah, that's very interesting, and maybe from my side, I would add a couple of points to that. So definitely, the onboarding process from insurers have been way stricter. They started to ask more questions, and if you look at purely from a credit perspective, insurers earlier were focusing more on the buyer risk, but now they're looking at basically the supplier risk as well, that how strong the supplier is, what is the quality of the supplier, how long they have been doing the business, what is the experience they have. And I think that's really bringing a kind of good quality portfolio to insurers. But obviously, there would be few cases going forward as well where insurers would try and learn and I think adapt to future. Now, the second topic which we have is around the credit insurance market. And Leroy, let me ask you that. Obviously, pandemic has been a kind of an eye-opener. We have seen, the trade being disrupted, private insurers pulling basically in number of markets. There have been a lot of government schemes as well in most of the European countries. Asia we saw, in US. How are you seeing the regional trade credit market basically evolving?
I think we need to kind of look at it kind of a trend and go back 24 months, pre-pandemic, then you had the pandemic, and now we're probably the beginning of the end of the whole COVID pandemic, hopefully. Pre-pandemic, if you look at, there was basically rates which went up post the global financial crisis in 2019. There was a correction to the market. And then from 2012 onwards, we've seen the softening of the market, plenty of capacity coming in. Liquidity was ample. We reached a stage pre-pandemic where it was not sustainable in terms of rates and prices, et cetera. Correction happened because there was a knee-jerk reaction. Now the credit insurers knew what the implications from a CAT perspective or systemic perspective as far as defaults were concerned as to what. So obviously there was a knee-jerk, there was capacity which was pulled out from the market and rates corrected. It's interesting to know that, again, and thanks to the governments, which facilitated fiscal stimulus measures and also became the backstop for credit insurers like ourselves, because magnitude like this cannot be handled by any private player. That facilitated back again confidence, that facilitated back again limits which we give, which people in the finance facility could trade and also lend against. Now we are in an era basically where we see risk appetite come back. We see a lot of capacity. We don't see so much of rate adequacy because why do I say this? It's very simple. If I look at our nearest line to credit insurance, the DNO or the ENO lines, we see rate rises of 30, 40%.
Yeah.
And in credit insurance, we've begun to see already a softening of market 10, 15, 20% on renewals. And I think it's important that to create a viable, there has to be good rate adequacy, which every player in the industry needs to kind of make sure that it happens, that risk is priced in an adequate way. Because obviously we're in a region which is prone to defaults, it's prone to certain risks which sometimes are beyond control of a seller, or a buyer, or a financial institution, or an insurer.
So do you think that insurers are pricing the risk in the region in a right way, or?
Well, I think it's plenty of additional capacity because there's a flight to quality. Everybody's chasing perhaps the pie, and obviously if everybody's going to be chasing the flight of good quality risk, there's going to be more competition. That's going to lead to obviously price wars and rate reduction. But as far as the market is concerned, is rather than cannibalization, which we see sometimes, the pandemic has also kind of created a lot of awareness for trade credit as a market. First-time buyers are more conscious about credit risk and the implications it can have to their cash flows, their balance sheets, et cetera. And that's kind of stimulated a kind of a natural growth. And that's where, because we see credit insurance penetration in the Middle East or the MENA region versus Europe, where the product has been there for 120 years, the penetration is still very low. And this is where people like yourselves and brokers who have invested in people and teams are doing a great job in growing the market. But I think it's important that everyone in the ecosystem should also bear in mind that they have sufficient rate adequacy so that it becomes more sustainable.
Yeah, I agree on the penetration part. Maybe I can give you a data point. Like Belgium is one of the most matured market when it comes to trade credit. But when you look at the penetration level there, it's 25%. So definitely, if you look at the GCC or UAE or across the region, we're looking at maybe less than 1% penetration when it comes to trade credit. Michael, obviously you have been managing the region from a very distant. But what's your perspective in terms of the overall credit insurance market in London, and also how London underwriters are looking at Middle East region from a risk perspective?
Good afternoon, everyone. So being based in London and representing the insurance market in London, we have a different perspective on and a different type of inquiry that comes to us versus a local trade credit insurance provider. So the perspective is different. We typically, as our organization, represent mainly financial institutions, and typically we're looking at single risk transactions and often of a medium to long-term nature. So probably more aligned to almost the ECA business, where we supplement the commercial aspects of transactions where ECAs are supporting similar structures. I think when it comes to credit risk, so looking at corporates, there's quite a high degree of caution taken by the London market. The NMC, and we spoke about fraud earlier, the NMC fraud from the region hurt the insurance market. Just our organization alone facilitated in excess of $50 million of claims, and we on average, as a general comment, represent about a third of most claims. So the insurance industry in London would have been hit by at least $150 million of losses on NMC. So immediately you get a loss in the region like that, insurers cut back and take a very conservative approach. So that's on the corporate side. There's definitely conservatism from the insurance market. I think when it comes to sovereigns, it's one of the lesser, the demand for insurance when it comes to sovereign risks in the region is less than other regions. So Africa is a very high demand area, Middle East, and to some extent MENA is a lower demand, which means that there is certainly quite a high degree of capacity available in the insurance market. And certainly, and obviously the risks associated to different countries varies, but there's reasonable demand for, obviously in a market like UAE, but also Saudi Arabia, even Egypt, Oman, there's quite high capacity. We've done some recent inquiries in challenging markets like Tunisia, but we've been able to find some appetite in the insurance market. So I think past sort of demand driven, there's definitely, and because of the low demand, there's definitely appetite for sovereign transactions in the region. But maybe from the earlier conversations that came through, I think there's quite a high degree of local bank support, which means there's less need for the international banks to fund the region, which results in less inquiries coming through to the international insurance market.
Okay, that's quite interesting. Sarah, let me bring you in. What has been your experience as a user of credit insurance product? Maybe you want to give some insight?
Yeah, sure. Good afternoon, everyone. So from my side, I'm the one who's relying on all of these guys in the support in order to secure the transactions and the working capital in general. So from my side, I think it's very essential based on my experience. I have 22 years of experience in corporate finance, and I have dealt a lot with credit insurance in order to secure the top clients in terms of credit risk and assessment, blue chip clients, and all of the basic stuff. But with regards to credit insurance, I think it's essential for every organization to do the basic requirement in terms of credit insurance, because at the end of the day, if any default or any risk, it will pay back. So there is the return on investment from that side. And in addition to that, it's also important for working capital managers or treasurers or financial controllers, CFOs, to have a look on a periodical basis on the quality of the data that's been shared from the clients. There is a challenge from the informants or sharing financial data. Then you have the challenge with the credit insurance to get the cover, because you can't. The informant's not able to get any information on the company. So it's always essential to have periodical reviews on the clients, and at a certain point of time, you have to say no to a certain percentage, whether it's it's worth the risk to do the business with them and offer credit or not. So I think this is in a nutshell from a simple point of view from my side.
Okay, well, thanks for that, Kevin. I think you have been waiting patiently. So again, we are sitting in a region which is obviously, quite sensitive. There are a couple of issues around, sanctions, because obviously there are countries in the region who are actually trading with a couple of other countries. So how do you see, when it comes to, money laundering, sanctions, and how that really impact or is affecting the trade finance activity in the region?
Sure. So I think everyone in this room probably knows that MENA has always been a challenging region for trade compliance, and that can be from, as you mentioned, Milind, the number of sanctioned countries in the area to the frequency of transshipment points to the difficulty of sanction screening Middle Eastern names to even kind of Western distrust of general traded companies, right? You put those all together and there's always extra questions or hurdles that need to be cleared for MENA-related trade finance. I think there was historically an additional complicating factor there, which I guess I would call maybe a culture of privacy, right, where there was a hesitation to provide certain documents in the KYC or transaction diligence phase, which would delay or sometimes derail larger projects or transactions. What we've seen over the last couple of years, I think, is a meaningful shift in that attitude. I think that's been driven largely by corporates and family offices and others who've realized that in order to participate in the more attractive deals and transactions, they have to be willing to give up that information, and that's kind of trickled down, I think, throughout to have a really sort of beneficial impact for the region, and that's very positive because it's coming at a time where trade compliance is only getting more complex. It used to be that sanctions compliance was easy, and it was the money laundering and the trade-based money laundering compliance that was difficult. Now, the trade-based money laundering compliance remains, difficult, and things like over and under invoicing and matching trade flows, like all of those, and we talked about the frauds, multiple invoicing. That's all sort of still there and difficult and challenging to monitor. But now the sanctions have gotten more complex as well. It used to be you could satisfy your sanction screening obligations by just running the parties of a transaction against a number of lists and making sure they weren't, they weren't on the list and they weren't from, Iran or Sudan or, another sanctioned country. Now with the introduction, primarily by the U.S., with my apologies, of, hybrid sanctions like the Russia-Ukraine sanctions or the Chinese military-industrial complex sanctions, all screening hits aren't equal anymore. Now you have to look and say, okay, yes, there was a hit on our screening filter, but does it mean we can't do the transaction, or does it mean we just have to be more careful? And so, we see a lot of questions about the Ukraine sanctions because I think the increased ties between the region and Russia and the region and China, have increased the impact of these hybrid sanctions. And so, a lot of times it's not that a transaction is prohibited, it's just is it structured so that it doesn't amount to an extension of credit to a listed bank, right? And so, those are sort of the challenges that we're seeing, and I think, one of the key parts here, because there's folks here that operate at all parts of the trade finance chain, is throughout making sure that it's clear to everyone who owns that compliance risk, right? Who is going to be responsible for onboarding clients, who's going to be vetting, the various parties. And then, and I know others will discuss this as well, in terms of future-proofing, designing the systems and controls now that can handle that, and to make sure that you've got the right systems in place, you need to have an appreciation for your risks, right? So you need to do a risk assessment to make sure that whatever you're putting in place is tailored to your risks. You need to make sure that it's updated regularly and has the capability to be updated regularly, right? Sanctions lists are changing, weekly, if not daily. We'll see what happens in the Ukraine, whether that's going to change some sanctions. There's still questions about, is the government of Afghanistan sanctioned? Is it not? And then, again, on the positive front, there have been a lot of changes in the region in response to FATF reviews and FATF scrutiny, particularly here in the UAE. Every couple of weeks there's a new money laundering obligation. So are your systems capturing that as well? And then, and then making sure that they're getting the right info to run those processes.
Okay, so that's interesting. And again, if you look at Russia and Ukraine, I think the situation is quite fluid at this moment because we saw some signs of de-escalation yesterday. But I think it's going to evolve, I think, in the next couple of days, and we'll see. Now, looking at Mansour, you obviously, Demica as a fintech, how technology is really helping you in terms of making a right decision? Because ultimately, Demica is bridging a gap which has been created by the conventional banking market.
Yeah.
So how are you making sure that you're actually picking the right client, and how technology is helping in that?
So I think as everything we've discussed, be it insurance, sanctions, or other items, all feed into fundamentally the value chain of this data and the data sets that we can analyze and we can work with. Fundamentally, as we look at credit models and we look at working with some of our bank partners in respect of developing some of these credit models, we're able to pull in pieces of information that then enable us to facilitate that bank in terms of building their various structures and building their various credit processes. But the key here, again, is that connectivity. The connectivity into not only the insurers and the bank systems, but also directly into the corporate CRP systems, to be able to get that historic view on performance, who they've been trading with. And then, as we look to develop future models, really continue to build on the data we have today. So from my perspective, the underpinning of all of this is access to data and how we can utilize that data to change the way in which we advance financing.
And Sarah, do you want to maybe share your perspective that how analytics is helping you to make informed decisions?
Yeah, I mean, again, everything boils down to data. So the quality of the data, how you utilize your system. So if you're inputting the right information in the right way, utilizing the full capacity of any software that you have in-house or outsourced, created for specifically credit risk or data analysis or financials reporting. So all of that boils down to really how you deal with data, from where do you source it, and how you maintain it on a quarterly basis or even on a day-to-day basis. So again, now we're in the tech era, so everything needs to be in a capacity that it's easily to be automated and transmitted through different softwares and be integrated together. So again, data is everything. In any informative risk assessment decision, you need to qualify the data that you are getting.
Yeah, Mansour, you want to
Yeah, I just want to add one more thing to that, and that's it's great to see other players coming into the market. For example, DP World and what they're doing with respect to their shipping data. The value that the market is going to derive from access to that information will be huge. So I think it's great to see more and more players coming into the market that hold a treasure trove of data, which will then enable the wider market to support credit decisions and lending fundamentally.
Okay, interesting. Now picking up, because if you look at the consumers of credit insurance, you have the corporate side, and one of the biggest one is banks. How that trend is changing in the region. So Leroy, maybe you talk about, because obviously if you have to compare Middle East to the markets like Singapore, London, or maybe US, what kind of or quality of deals basically are you receiving? Or what is the driver for banks basically to use this product?
Yeah, again, it'd be good to kind of suggest a trend as to how the product has evolved over the let's say the last 10 years. I think if you go back then, it was a typical vanilla multi-buyer, whole turnover type of policies. That changed in 2015, where you see more of the London market players, structured trade coming slowly into the market, the banks being more receptive, brokers like yourself investing in teams to educate the market. We've seen political risks inquiries also now started kind of coming from locally in the market. So there has been a real good trajectory in terms of the breadth of the product, the subclasses of just the holder or multi-buyer. And I think that's where the market is going to go. Obviously, it's still not there as if you compare it to the level and the volume you see in the London market, or if you see that in Singapore, where you see a big portfolio of especially structured trade, quasi-CF type of transactions, lesser degree of political risk insurance because that still goes back to the center, which is the London market. But we've definitely seen a good change, at least in the last 3 or 4 years. And I think this, if you go forward, I guess you'll see more and more of it. Obviously, if you now have an ECI in the UAE, you have the other countries also who are supporting the trade. You have the private market. I think it's just going to improve and just grow over a period of time. And I think if you give it another 5 years, probably catch up with at least with Singapore.
And do you see a change? Because obviously you have been in the region for quite a long time. There was a period maybe 5 years ago when obviously banks were using insurance as a kind of a way to mitigate the entire risk. Obviously, there were, I would say, few cases where the understanding of banks on using the product was completely different than what insurers were actually putting in the policy. Do you see that understanding has matured over a period of time?
Oh, absolutely. There's a lot of maturity, and the gap of the expectations between insurer and the lender has kind of narrowed quite dramatically. Again, if you go back, to the market 10 years ago, typically a credit insurance policy was just kind of issued if there was a lender in the policy, the lender became a loss payee, which is probably has no rights, no benefits. If there's a claim, if the claim is valid, accepted by the insurer will then pay the loss payee. And obviously that, traders took advantage of that. A parallel market was created, and credit insurers' image was kind of damaged because pretty much at that time, because of the gap in knowledge, people didn't understand how does a credit insurance policy respond. It's not a guarantee, it's an indemnity policy. There has to be a valid claim. There doesn't have the documents, there has to be a legally enforceable debt. That gap is now changed thanks to the broking community, thanks to the banks investing in people who understand the product. And we see in a whole different, now with banks becoming insured, we see more structured traders saying earlier. And this is a positive change. This is what's needed because this facilitates growth. This kind of helps push credit to the market where it's actually needed. And the more innovative we are in the right way, and again, future-proofing, of course, the fraud element which creeps in, because the moment you have fraud which creeps in, it kind of takes us back things. And things like, for example, a great product like buyer credit, so obligo, we call obligo finance or something of that sort, was misused to a large extent. But I think it's a great tool because it's an alternative. It's somewhat more flexibility if there's kind of trust receipts or letters of credit facilities, etc. But it has to be given the right obligor. It has to be kind of structured nicely and kind of made sure that, with the help of technology and things like that there's no collusion with supplier and the obligor or something. There's actual genuine transactions. It's where it's self-liquidating in some respects, and therefore, you're moving from the balance sheet of the obligor more in terms of to the transaction. So all these things have changed, and if you go back, these things were not there 10 years ago, thanks to people who have invested and come here and created this market, and it will just grow from now on.
Okay, that's very interesting, and maybe from you, Michael, because obviously you're looking at the corporate and also a lot of banks in London. How are you seeing that inquiry, basically trade flow, coming for the region evolving from your perspective?
So I think I agree with a lot of Leroy's comments. I think the insurance sector's product range has expanded quite significantly over the last 10 years. So now the sector will cover short-term LC trades, supply chain finance, into medium-term loans, and now including supporting long tenor project finance. So you can now get, particularly if it's in the renewable energy, you can get 20-year policies out of the private insurance market, something that 5 years ago was impossible. So the insurance market is evolving continually and upscaling the product offering. And a lot of that's been driven by the demand from the banks for the product. A critical issue that, again, Leroy highlighted is the fact that more and more the bank has become the insured. So in supply chain finance, and I think Greensill is a perfect example where there were lenders to Greensill and then investors to the lenders who haven't necessarily seen the benefits in that, and that was partly because they didn't have control over the policy. So now there are Basel compliant supply chain finance insurance products out there, but the critical element is that the financial institution is the insured and controls the policy, which means they can control the claim outcome. So those are all important developments that have taken place in the sector. I think within the MENA region, it's still, as I said before, it tends to be there's a lot of local bank liquidity, so it's not as high a demand sector. Maybe looking at some future developments, one thing that we are seeing a lot is non-bank financial institutions wanting to apply their funds, particularly looking and chasing sort of higher yield assets. That we don't see that necessarily competing with the bank sector. So what we see a lot is that the bank sector likes to arrange and structure these deals. They like to earn fees for the arranging, but they don't always want to hold long-term the asset on their balance sheet. And that's where the non-bank financial institutions and it's a perfect complement because they're not chasing the fees, and they're also not that, they don't have the capabilities to do the arranging that a bank's got. But they've got these big balance sheets and they're looking for yield for their investors. So one of the trends that we're starting to see are banks trying to structure deals and then maybe putting them into an SPV and then attracting non-bank financial institution investors into the SPV. And we're increasingly starting to see an insurance angle within that. While the non-bank financial institutions are chasing the higher yields, because they are deploying investor funds, they're still cautious about the risk and are not necessarily well geared to take risk in emerging markets. So if you can wrap that structure with an insurance product, then it's a perfect arrangement. They can get the higher yield, but you've got an A-rated insurance policy to protect the investors.
Okay. Mansour, any insight from you? Because obviously you're in the similar space.
Yep.
Obviously you're sitting on the other side and providing, as I said, the gap created by the banking market. How are you seeing basically that area of growth basically developing for you?
Yeah, I think the point around the growth of the originate to distribute model over the last 5 years, it's just grown significantly. The volume of liquidity in the market has meant that there are a number of players who don't have the capability to service these portfolios, but have the cash and want the yield from the portfolios, so are willing to invest into third parties and third-party transactions. We've seen a lot of push for quality in that, which is a really interesting position to take given the high yields that those assets are hunting. But fundamentally, with the insurance products and with the insurance wraps that you're able to put over a sort of initially purchased portfolio by a large bank, you're then able to have that at sort of lower credit quality wrapped by the insurance policies to address some of those fundamental servicing risks. And if the lead bank continues to service that portfolio, again, those third-party funds are not gonna have material concern over that. So we're seeing growth in that aspect, which is addressing some of the liquidity gaps that we see specifically in the SME space, which continue to be challenging in the market. And I'm not really sure today how, with the pullback of government funding across various markets, and it is across the GCC as well as the UK and other markets, with the pullback of government support for these entities, where that additional liquidity will come from today. And that's a gap that I'm presently seeing opening up.
Okay. Thanks, Mansour. And Sarah, from your perspective, because...
Yeah, I mean, specifically for SMEs, so I've worked with corporates like Creighton, which is 100,000 employees, over 100 countries. Easily, I can pick up the phone and call the banker and request support from financing to any country that I would like to allocate. But coming to the SME side, it's the different world because you don't see that support. It was shocking for me in my first role in an SME coming from corporate, the difference in relationship, the difference in the support, the difference in the product offering. the rates, the fees, everything is just completely, does not support an SME to grow and to be supported from the funding requirements that needed. So I've worked in getting funding through suppliers relations, through, again, the new entry into market with invoice financing, with higher yields, lower requirements, lower KYC, and all of that. So again, at 12%, it's huge for an SME with a small transaction and smaller margins. So I see that gap still there as of today. We speak about it. It's maybe improving slightly, but again, to be able to find the right source of financing or support or even credit insurance for your clients, it's a huge challenge from a cost perspective.
Interesting. Maybe I'll just 1 minute maybe.
A few questions for you.
Okay, sure.
A few short questions. Just a first general question to the panel. On your risk barometer, political risk barometer, is the needle heading green or heading red? That's the question. On your political risk barometer, is the needle heading green or red? Political risk, is it going up or going down? I guess that's the question, you know. Heading red or heading green?
I don't think it's a, you know, when you've got to look at political risk, you've got to look on a global perspective, and the risks in different regions are changing. I think certainly the political risk as a standalone product there is elevated risk in the world at the moment, and the obvious example is the Russia-Ukraine situation, which were markets where people and foreign investors were targeted. They enjoyed those markets, and suddenly they're seeing this elevation in risk in markets that they didn't predict before, and you know, who knows how big this problem could be. We've seen in Africa in recent years an increase in coups that have taken place. So I wouldn't say the risk is necessarily increasing. We're certainly not seeing an increase in claims, but certainly these pockets of events that are taking place has brought to the forefront the concern that there is political risk, and certainly we're seeing an increase in inquiries of a political risk nature. But as I say, that's not translating into actual losses.
Very good. I've only two more, and they're short. Someone commented, very frank and open panel. On the subject of fraud in SCF, has this development impacted on the SCF product being offered by banks?
Maybe Leroy, you want to take that? Like, how do you see insurers' appetite reducing on supply chain finance?
Good.
That's a very good question. I think it's not so much a reduction of appetite. I think it's more in terms of flight towards better structure and quality. And again, what we spoke about, you know, how the product has kind of evolved in terms of more mature structures, the bank being insured, having more control, making sure its technology embedded into the documentation is right. I guess we as insurers, we see it's right and it makes sense. That's where we would have the appetite to kind of do it. Where it's kind of moved away is obviously from past experiences, and I said we kind of study these experiences, is that if you kind of participate on something for short-term gains, it's going to come back and haunt the system, it's going to be a default, and everybody's impacted. But definitely, from my perspective, you know, SCF is more structured, is going to be more structured, more tightly controlled because of digitization, and it's definitely going to increase appetite over a period of time.
Yeah, just to add to that from my side, I think we haven't seen material impact or reduced appetite, to be frank, across the market. I think regionally we saw an impact post the situation that happened sort of 2 years ago, and I think the accounting standards are going to be the biggest impact to this market, and whether corporates are willing to disclose or wish to wind down programs. I think ultimately that will be the biggest change that we will see.
Great, and last one, and it's for Kevin. Kevin, how are banks evolving their technology to fight financial crime? And then there's a little dash at the end. Are they keeping up or being left behind by, I guess, the bad guys?
Well, I mean, I think Leroy made this point earlier, which is, you know, bad actors are always going to find ways and to exploit the systems that are in place. I do think that banks probably in the last 3 or 4 years are doing a better job than they did historically. I think part of it is collaboration with various fintechs. I think some of it is also being pushed and trying to internally compete with what the fintechs are doing, but they've, where historically they've been, I think, pretty cautious and risk averse in adopting new technology, they're more willing to try that out. I think part of that is there's more encouragement and openness from regulators to let them do that. I mean, that's historically been one of the main stumbling blocks, not necessarily just the risk aversion of the banks, but the risk aversion of the regulators. And as regulators are looking into, fintechs and virtual currency and all these other things that are going on, they've just become more technically savvy themselves. And so when the banks go in, they can explain the changes that they're making and get a more receptive audience from their regulators. So I think there's still a lot of work to be done, but I think, that trend is accelerating and they're doing a better job.
Well, Milind, that's my last question from the app. Back to you.
I would just add maybe 3 points on the bank discussion which we did, and I think that's just picking up from the comments, Michael, you made and Leroy. So the first thing obviously we have seen in the last maybe 4 or 5 years is the number of solutions which are available in the region. So if you look back maybe 5 years ago, it was primarily the trade credit, the whole turnover portfolio policies. But now you have a variety of products which could be, the single buyer, PRI cover, NPI. So I think the banks have a lot to choose from an insurance perspective. And the second thing I would say in terms of the maturity of banks, because obviously banks have gone through like a process of, learning by their own experience and understanding the market. So I think that maturity level has gone up significantly higher. And the third thing we need to look at is what is really driving banks to use insurance as a distribution partner. If you look at maybe in more of the matured market, it's primarily the capital relief, which is not the key concern for banks here. It's primarily the risk mitigation or maybe the limit management. Yeah. And this is where the insurance becomes a cost for banks. But once banks start to use insurance as a tool to reduce the RWA, I think that will become basically a position where I think each of us we want to be from the industry perspective. So yeah, these are the 3 points. Any questions more?
Any final question? I think you've done a wonderful job. I think you've covered everything. So could we give this panel a please nice warm round of applause? Milind, really great job. Great job.